Welcome to our 2018 webinar series. In case you didn't know, 2018 marks LLIS's 20th anniversary. Each webinar this year will involve the number 20. Included in each webinar are advisors' requests for specific information from the 2017 webinar surveys, so watch for a question you may have submitted. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them. We'll do our best to answer them as they come in. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. And throughout 2018, loyal fans will receive 9 CFP CE credits, 1 for each month. And who knows, maybe one lucky viewer will have a chance to win a 20th anniversary gift from LLIS. Today's presenter is constantly monitoring the changes in annuities and hybrid insurance combos to ensure your clients are getting the most up-to-date solutions. He joined LLIS in 2008 and has over 20 years analyzing, studying, and researching annuity and hybrid solutions. Here to share all his knowledge on hybrid insurance policies is Jerry Skapiak.
Thank you, Claudia. All right, so today we're going to talk about 20 useful facts for hybrid long-term care policies. And how we're going to do that is we're going to cover a few different policies. We're going to cover hybrid annuities, hybrid life insurance, and joint hybrid life policies. So, but first I want to start with is why don't clients purchase long-term care insurance? One of the number one reasons that we hear why clients will not purchase long-term care insurance is that they don't want to pay for something they may never use. When you look at other types of insurance that most of us have, it's kind of astounding to me. If we look at homeowners insurance, what are the odds that your house is going to burn down? Well, as you can see from this, it's less than 3%. This just breaks it out by men and women. We all have auto insurance. I don't want any jokes coming back to me about how these numbers are broken out. But yes, women do put in claims more than men on the auto policies. That may be because men don't want to take blame for what they've done, or they're embarrassed to put a claim in for something stupid they did. But we all have these policies. We don't like paying the premiums for them, but we do pay the premiums for these policies. I don't know of anybody who gets ecstatic when they get to put a claim in on one of these policies. But when we start talking about long-term care insurance, clients, for some reason, have a different view on that type of insurance. They don't want to pay for something they may never use. Even though we see here, we have homeowners insurance, it's less than 3% chance we're ever going to put a claim in it. Or our auto insurance, we're less than 18%. But when we look at long-term care insurance, for women, there's a 72% of the time they do put in a claim for some type of long-term care, and men is 44%. Why are men lower? Well, probably for two reasons. One, men die before women, and two, men more often than not need care before a female does. So a lot of times, if it's a married couple, the female spouse will take care of the male spouse. That's why we see a little bit lower usage for men with long-term care policies. So when we start talking about hybrid policy, who is the ideal client for a hybrid solution? Well, one, it's going to be someone who wants guaranteed premiums. We've all had clients with traditional long-term care. I'm sure they've come to you saying, I have this policy and now I'm getting this premium increase. Yes, no one likes to receive that notice that their premiums are going up. With the hybrid solutions, everything is guaranteed. So that means your premium is guaranteed. You're never going to get a premium increase on a hybrid policy. They want guaranteed return of some form of a benefit. With long-term care insurance, you pay those premiums every year. If you never use the policy, clients feel, well, the insurance company won. I never got any benefit out of that policy. With the hybrid solution, someone's going to get some type of benefit. If it's a hybrid life policy, if the benefits are never used, the beneficiary is going to get a death benefit that's going to be paid to them. If it's a hybrid annuity, whatever the account value left in that policy is will be paid to the beneficiary. So someone's going to get some type of benefit out of that policy. Clients want payment options. With traditional long-term care, your only payment option is level annual premiums. With the hybrid options, you have several different options. You could do a level premium. You could do a short pay, like 10, 20 years. Even a single premium you can do in it. But you have payment options with the hybrid solutions. So clients really like that about them. They like the idea of long-term care, but once again, they don't want to pay for something they may never use. That's the number one objection to these policies, to long-term care. Clients want an elimination period greater than 1 year. You all have clients that have some assets. They can sustain, a long-term care event for a short period of time. With the hybrid policies, you get that elimination period that's greater than 1 year, because when a client goes on claim, they use their own money first with hybrid solutions. Some clients that don't qualify for traditional long-term care, they may qualify for a hybrid option, and that's specifically talking to the hybrid annuity. It has much lenienter underwriting than traditional long-term care. You may have clients that have an existing annuity or life insurance policy with cash values that they no longer need it for the original reason it was purchased. The annuity, they may have bought it, maybe they thought they were going to use it for income in the future. Now that they're getting closer to retirement age, they saved enough of their assets, they don't really need to use that annuity for income. Or with life insurance, they bought it when they were younger, it served its purpose, it covered them when they need it. Now that they're older, they don't necessarily need the life insurance anymore, but they've got this cash value built up in this policy. So what do you do with it? Well, one of the options you can look at is transferring that via 1035 exchange, which is a tax-free exchange, over to a hybrid life policy. And finally, number 8, for your clients who can self-insure, the hybrid policies are a great option for them. As I said, with the hybrid policies, you are using your own money first when you go on claim. So clients who are going to self-insure, they can still use their own money first, but we can create a much bigger pool for them. You ask, how big of a pool can you get? Well, let's look at some examples that we've had. We had one client who had $123,000 in a life insurance policy. They no longer needed the life insurance on that policy, but they had a need for long-term care. We were able to take that $123,000 and turn that into a $567,000 long-term care pool. Now, if that client had not done this and they needed long-term care, their long-term care pool would only have been $123,000. But now by doing that exchange, that tax-free exchange to a hybrid life solution, now they have a long-term care pool that's over $500,000. Another example, I had a client with $175,000. We gave them an unlimited long-term care pool. And we had another client that had $100,000 that they just wrote a check for, that gave them a $250,000 long-term care pool. So these hybrid solutions are a great way to expand the client's money into a much bigger pool for long-term care. So now let's start taking a look at some of the different solutions we have. First, we're going to look at the hybrid annuity. So what is a hybrid annuity? Well, first, it is a fixed deferred annuity. You cannot get this policy as a variable type of product. It is only offered as a fixed annuity. Long-term care benefits are multiples of that single premium. You're going to see that when we go through a couple of case studies coming up here. You can do a 1035 exchange from a life insurance policy or an annuity to the hybrid annuity. So just to go over the 1035 exchange rules with insurance, you can go from a life insurance policy to another life insurance policy or to an annuity. If the client has an annuity, you could only go to another annuity. You cannot go annuity to life insurance. Long-term care benefits not used, it's still an annuity. So whatever the account value is of that annuity when the client passes away, that is paid to their beneficiary. Or if they want to use that money in that annuity for income, they can annuitize it, they can take withdrawals, has all the same benefits and features as a traditional deferred annuity, just offers that additional benefit of long-term care on it. And currently, this is only available as a single premium, and it has to be non-qualified money. So you cannot make premium payments into this. And boy, I wish we could use qualified money, but we are not able to do that. It has to be non-qualified money. And finally, we can easily cover a spouse on this. So even if the client has an individual policy, let's say the husband has an individual policy, we can do a 1035 exchange to the hybrid annuity, and then we can add on the spouse as another insured on the policy. So they both can get long-term care coverage with this policy. So what do you get with the hybrid annuity? Well, it's a fixed deferred annuity. You're going to get guaranteed monthly long-term care benefits, and you're going to get a guaranteed long-term care pool somewhere between 60 and 138 months. And we can't forget, we can add a spouse on so couples can get the insurance together. So let's take a look at a case study here. Here we have Carol, who's 63. She lives here in Florida. She was declined in the past for traditional long-term care. She was taking pain medications for her knees, and the doctor also recommended that she have 2 knee replacements. Now, with traditional long-term care, anytime you're recommended to have any type of joint replaced, it is going to be an automatic postpone until that joint has been replaced and the client has completed their physical therapy after having it replaced. But Carol, she understood the need for long-term care. Talking to her advisor, the advisor came to us with Carol's situation, and they wanted to talk to us about options. And we actually had a conference call with Carol and one of her 2 children. The reason Carol had one of her children on the phone call is she wanted them to understand why she was getting this coverage, and also for them to understand is why she was taking money out of her estate to provide this long-term care coverage. So what we looked at for Carol is, because of her medical history, the hybrid annuity is a great option for her. So with the hybrid annuity, there's 3 options. First, Carol is going to put in $100,000. So that's what we have here in all 3 of the options. You'll notice right at the top is the $100,000 annuity value. With the annuity, it's broken out into 2 parts. You have your money and the insurance company's money. The insurance company's money is this, what they call the long-term care extension. And it comes in 3 options. You can either have a 36-month, 72-month, or 108-month extension added to the annuity. So let's take a look at Carol. She has $100,000 she invested into the hybrid annuity. And when we look at the 3 options at the end of year 1, this is what the values look like. First, we have the cash value, which is her money. As you see, end of first year, option 1, it's growing to $100,168. Now, we are all grown-ups here. We know nothing is free in this world. With the hybrid annuity, there is a cost for that long-term care portion of the annuity. And that's why we're seeing such low growth of the cash value, because behind the scenes, there is cost for that long-term care that is coming out of that cash value of the annuity. you'll notice with option 2, the cash value actually went down a little bit, and with option 3. The reason for that is because the greater the long-term care pool, the larger that cost is for the long-term care. So what we have in this box here now is now we're talking about the actual long-term care benefits of the policy. So the long-term care accumulated value is nothing more than her original premium growing at a little bit higher of an interest rate. So when we start looking at what is going to be the actual long-term care benefits, we start looking at this long-term care accumulation value. Then we have the rider, and remember, option 1 was 36 months, option 2 72 months, option 3 is 108 months. That's why we see that pool grows from 150 to 300,000 to 400 and almost 450,000. That's all because of that extension for the long-term care part of the policy. So when we look at what is the total pool of long-term care, well, it's her long-term care accumulation value, which remember is her own money, and then the long-term care extension rider. So you'll see the difference in the pools. Obviously, option 1 has the smallest pool, option 3 has the largest pool. But option 1, when we're looking at how this is broken up, when it's an individual, the first 24 months of claims, the client's using their own money. So we have 24 months of their own money, 36 months for the rider. So they have 60 months or 5 years worth of benefits. So what I always say is when we're looking at an individual, I want to focus on option 1. That's providing 5 years of coverage, which is more than the average amount of time anybody's going to need long-term care for. Now, if you got a client, they're concerned with getting a bigger pool, by all means, we can do that. We can look at option 2 and option 3. We do start with a little bit lower monthly long-term care benefit. So you see with option 1, it's $41.78. Option 2, it drops to $41.63 and $41.54 for option 3. So let's fast forward to age 80 and take a look at what these values have done. We see very little growth. If not, we got it kind of actually decreasing a little bit with option 2 and 3. And once again, that's because of that large long-term care pool. But for Carol right now, if she goes on claim at age 80, she's going to get $4,355 a month. In fact, let's take a look at how does this policy work when a client goes on claim. So we're just going to focus on option 1 now with this. So she's going to go on claim, and she's going to receive $52,260 a month in long-term care benefits. That is going to be subtracted dollar for dollar from her cash value, and that's what we see happening here. So it comes right off her $102,000 cash value. So end of year 1, she has a little over $50,000 left. That is also going to be subtracted dollar for dollar from her long-term care accumulated value. Remember, that's her own money growing at a little bit higher interest rate. So that's dropped down to $52,263. Her long-term care extension, that doesn't kick in until we've depleted this long-term care accumulated value. So with 1 year of claim, it's not even touched. And then as we look, her long-term care pool goes from 261 down to 209, all subtracted dollar for dollar. So she's received at the end of year 1, $52,260. We go to year 2, the same thing happens. We're subtracting dollar for dollar from our cash value and our long-term care accumulated value. So at the end, there's no cash value left in the annuity. If she passes away at this point, there is nothing going to her beneficiary. She still has $3 left of the long-term care accumulated value, and her long-term care pool's down to $156,000, but she's already received $104,000 in benefits. That's more than the original premium she put in. Year 3, claims continue. We take the last $3 of that long-term care accumulated value. Now we're going in and taking from the long-term care extension rider. This is when the insurance company is now on the hook. This is really why we bought this policy, is so that the insurance company is going to pay these additional long-term care benefits above and beyond what the client had in cash for this event. And this is going to continue until that long-term care extension rider has been depleted to zero. So at the end of year 3, she's received $156,000 in benefits. All right. So let's talk about Tom and Rita. They're both age 60. They live in Alabama. They wanted to apply for long-term care insurance with shared care. Couples like doing things together. Tom was insurable, but Rita was uninsurable. She had a history of 3 TIAs. Those are like mini strokes. Tom had this annuity with almost $155,000 in it. The advisor, working with us after we discovered that Rita was not insurable, we presented this alternative to them, a way for both of them to get coverage. Even though the annuity was just in Tom's name, we are able to cover Rita on this policy also. So with the joint hybrid annuity, it works just like we saw with the individual hybrid annuity. It's a couple minor changes. If you remember, I said our long-term care, our accumulation value was depleted over 24 months for an individual. Since it's a couple, it's depleted over 30 months. We also have the same extensions on here for the different options. We got 36 months, 72 months, and 108 months. But the rest of the annuity still works the same. Now, when I have a couple, I like to recommend they go with option 2. This is going to give them a little bit bigger pool. The reason I want that bigger pool is because they both can receive long-term care benefits. So this monthly long-term care benefit of $4,900, they each can receive that. So they can be on claim at the same time and receive, $9,800 a month that they each could receive, or as a total they could receive, or as annuity can pay out that much money every month if they're on claim together. So let's take a look. If they do go on claim together, how does this affect the annuity? Kind of like we saw with the individual, except we have larger amounts coming out. So their cash value was $144,000. In the first year, they're taking out $177,000 in long-term care benefits. Oh, and by the way, all these long-term care benefits are paid tax-free. So if you have a client that have an existing life policy or an annuity that has a gain in it, it's a great way for them, or I guess it's a great benefit that they're able to receive these long-term care benefits out of the hybrid annuity, and they're going to receive them tax-free. Whereas if they had surrendered those policies originally, they would have been taxed on them. Going back to our hybrid annuity, they're going to receive the $117,000. That's also going to be subtracted from the long-term care accumulated value. And we're not touching our long-term care extension rider yet because we still got money left in our long-term care accumulated value account. And once again, subtracted dollar for dollar from the total pool, they've received at the end of year 1 $117,000 in long-term care benefits. Go to year 2. Well, we had $26,000 left in cash value, so that's going to be, we're going to use that up that first year. So now we have 0 cash value. We're also going to use up the remaining $29,000 of the long-term care accumulated rider, which is fine. But now the insurance company's on the hook. In that second year, insurance companies out of their pocket already $88,000. And they still have over $250,000 left to receive in benefits. We've got that. We've got our long-term care benefits paid out, almost a little over $250,000 of benefits paid out. Go to year 3, there's no cash value, no long-term care accumulation value. The beautiful thing is it's all on the insurance company's dime. They're paying another $117,000 to them for long-term care coverage. They've received now almost $353,000 in long-term care benefits, and they still have $250,000 in benefits to receive. And then this will continue for the next 2 more years of receiving benefits, actually a little over 2 years of receiving those benefits tax-free from the insurance company to keep paying for this long-term care event that they're experiencing at that time. All right, so that's all I have for the hybrid annuity. I hope that made a lot of sense to everybody. Let's change gears and talk about the hybrid life policies. So what do you get with the hybrid life policies? Well, there's two ways to structure them. You can either maximize the death benefit or maximize the long-term care insurance of the policies. We have funding options with it. We can do a level pay. We can do a 1035 exchange from another life policy. So that policy, that cash value that's in that life policy can now do double duty. It can provide a death benefit and it can provide or provide long-term care benefits to the client. And we have payment options. We can do a 10 pay or shorter with these policies. There is underwriting required on them. And long-term care, if it is not used, it's a life insurance policy, has a death benefit that's going to pass tax-free to the beneficiary. So let's take a look at Mary. She's 58, she lives in Illinois, and she has a life policy with $123,000 of cash value. That's great that she has it. But this policy has a cost basis of $98,000, so it has about a $25,000 gain in the policy. And Mary has a need for long-term care. Being 58, she didn't really need the life insurance anymore at this point, but she didn't want to surrender the policy because she didn't want to pay taxes on that $25,000. So the advisor came to us and asked us, so what are the options we have for this? Is there a way we can get her long-term care coverage with this money in the policy? I believe they actually called to see if they could do a 1035 exchange to a traditional long-term care policy, which is not possible. So what we presented for Mary was hybrid life solution. Now with hybrid life, there's two types. I call them traditional or a supercharged. I am a Mustang guy, so I like to use pictures of Mustangs. So here we have our traditional hybrid life policy, or what I call a traditional Mustang. So what do you get? This policy is going to maximize the death benefit for the client. We are going to have long-term care benefits that are going to be equal to 2% of the death benefit. So if we have a $100,000 death benefit, we're going to have a $2,000 monthly long-term care benefit. And we get guarantees. The premium, the death benefit, the monthly long-term care benefit, and the long-term care pool are all guaranteed. There are no current assumptions on these policies. Everything is guaranteed. So let's take a look at this traditional hybrid life policy. So we have her $123,000 premium. That is going to buy her a death benefit of $375,000. Excuse me. Her monthly long-term care benefit is 2% of that death benefit, so it's going to be $7,509, and her long-term care pool is equal to her death benefit. Fast forward to age 80, all the numbers are still exactly the same. There's no growth, there's no inflation on this type of policy. But what if she goes on claim at age 80? Well, let's take a look. Remember, any benefits paid out are subtracted dollar for dollar from your cash value and your death benefit. So she's gonna receive $90,000 a year in long-term care benefits. That's going to be subtracted dollar for dollar from the long-term care pool, which is also equal to her death benefit. So at the end of that first year of claim, her death benefit / long-term care pool has been reduced now down to $285,000. That's great. If she passes away now, she's received $90,000 in long-term care benefits, and her beneficiaries are going to receive a $285,000 tax-free death benefit. Perfect. Also, that $90,000 she received in long-term care benefits, that was paid to her tax-free also. So if we go to the second year of claims, same thing's going to happen. Subtracted dollar for dollar, the $90,000 she receives, her death benefit and long-term care pool is reduced down to $195,000, and she's received $180,000 in benefits. she's already received more in long-term care benefits than the premium she paid into it. Great. Year 3, she's continuing to receive her benefits. $90,000 a year, subtracted dollar for dollar. Her death benefits reduced to $105,000, and she's received $270,000 of tax-free long-term care benefits. And if she dies, her beneficiaries get a $105,000 death benefit, which is just under what her premium was. And this is going to continue until she depletes that death benefit / long-term care pool. Now, this is all great. We talked about, this example with a single premium, but what if your clients don't have a single premium to pay? That's no problem. We're going to talk about Jimmy, who's 62 in Minnesota. He needed long-term care insurance, but he doesn't want to pay for something he may never need. Common thing we hear all the time here. But he didn't have a lump sum to put down on a hybrid policy. No problem, because with these policies, you can make annual premium payments in them. So Jimmy's 62, he was a standard non-tobacco class, and he wanted to look at a level pay policy. He wanted to receive $5,000 a month in long-term care benefits. Well, since we know that our monthly long-term care benefit is 2% of the death benefit, so we had to go with a $250,000 death benefit. Nationwide has a premium of $6,511. I want to go all the way over here to payout method, indemnity with this policy. Traditional long-term care policies are reimbursement policies. That means the client has to incur the expenses and then they are going to be reimbursed for them. With an indemnity policy, it works a little bit different. As long as you have one expense that month, doesn't matter how much it is, could be $10, the insurance company is going to send you the check for $5,000. Makes it simple. Don't got to keep track of receipts. It's a great benefit with these policies. But with these, what I call these traditional hybrid policies, you have several companies that offer this kind of policy. Here we have Prudential. Premium's a little bit lower. Same exact benefits. Why not go with Prudential? It costs less. Or what about American General? Going to save even a little bit more. There's no reason to not go with the least expensive company when we're looking at these types of policies. Now, I want to talk about two other companies here. Work kind of similar, but have some different features to them. First one is State Life. You'll notice we dropped the death benefit down to $125,000. That's the first thing. And then you notice that infinity symbol in the long-term care benefit pool and benefit months. That's because this policy offers lifetime benefits. So you can't outlive them. They also allow us to go from 2% of the death benefit up to 4% of the death benefit. So that's why we're able to drop that death benefit down to $125,000. Why do we do that? Because it brings the cost of the policy down when we do that. The goal of this policy shouldn't necessarily be the death benefit, but should be what can we get for long-term care coverage. With this policy, we're going to get $5,000 as long as we need with long-term care. And one other company is Columbus Life. They do it a little bit different. Instead of providing monthly long-term care benefits, what they say is that once you qualify for long-term care benefits, we're just going to write you a check for 40% of the death benefit. In this case, it would be a check for $100,000, and they're paying that to you as a lump sum. Now, a question I often get asked is, what does it take to qualify for long-term care? Well, the IRS actually sets those qualifications, and that is the client has to not be able to do two of the activities of daily living or have a severe cognitive impairment. So as long as they meet that requirement, it's typically insurance company will provide a form that their physician has to fill out saying they meet either two of those activities of daily living or they have that cognitive impairment. And that is what will be the triggering factor for them to qualify for long-term care insurance. So now once again, my Mustang, but now we're going to look at supercharged policies. These are really one of my favorite types of hybrid policies. So what do you get with the supercharged policy? One, it minimizes the death benefit of the policy. Okay, well, that's great. What it does is it maximizes the long-term care benefits. It also, we can add inflation on it. We have benefit periods. This is starting to look more like long-term care insurance than it does life insurance. And after 5 years, we can get a full return of premium, and even on some policies, you can have a return of premium starting in the first year, or some part of return of premium in the first year. So the way I kind of describe these policies, it's like having a long-term care policy with a life insurance wrapper around it. So here we have Tony, he's 58. He has a whole life policy, has a $328,000 death benefits, got almost $44,000 of cash value, and his cost basis is about $115,000. Now Tony, he doesn't need that life insurance anymore, but he has a need for long-term care insurance. So the advisor came to us, asked us to do a review of his policy and to see if there was any way we could use the cash value in this policy to provide him with some long-term care benefits. So what we did is we looked at one of these supercharged hybrid life policies. So using Tony's $143,000 cash value out of his policy, we did a 1035 exchange to one of these supercharged hybrid life policies. So what I want you to know is, first off, is the death benefit. It's only $257,000, almost $258,000. Not very much more than what that premium was that went in. We have return of premium right now. It's at $115,000. In this 6th year, we'll have a full return of premium. But take a look at this. Our monthly long-term care benefit is $7,305. His long-term care pool is $366,000. So it's over twice what that single premium that he put into the policy. But this policy has one more thing. It has inflation. In fact, he went with 3% compound inflation. Now, where that makes a big difference is when we take a look at what the values are at age 80. Look at that. That monthly long-term care benefits growing to almost $14,000. The long-term care pool is $702,000. Look at that difference. He put $143,000 in. Now he has a $702,000 long-term care pool. His death benefit, it's went down a little bit. Why did it go down? Well, the IRS says with life insurance, the death benefit has to be a certain amount over whatever the cash value is of the policy. That's called the corridor. As you get older, that corridor shrinks. So that's all what we see happening here is between 58 to age 80, that corridor has shrunken and his death benefit's been reduced to $191,000. That's a good thing because what does that do? That keeps the costs lower in the policy, meaning it gives him more long-term care benefits. His return of premium at age 80 is equal to the original premium he put in. So let's take a look at how this policy works when benefits are paid out of it for long-term care. So at age 80, he goes on claim. He's going to receive that full monthly benefit of almost $14,000, receives $167,000 a year. Remember, benefits paid out are subtracted dollar for dollar from your cash value and your death benefit and your long-term care pool. So we see the $167,952 subtracted from all three of those. So at the end of year 1, you'll notice our return of premium, we've used all the cash value up in the policy. There's nothing to surrender at this time. He's in this to use the long-term care benefits. That's fine. His death benefits now reduced to $23,000, but he still has over $500,000 of long-term care benefits. Go to year 2. Notice our monthly long-term care benefit went up. That's because of that inflation. It doesn't stop just because you start receiving benefits. It continues to grow as long as that policy is in force. So he's going to receive the $14,400. It's subtracted from the long-term care pool, the death benefit, and there's nothing to subtract from the premium. So at the end of the second year of claim, our long-term care pool has been reduced to $361,000. Our death benefits reduced to zero. But what these policies have is they have a residual death benefit. It's actually about 10% of the original. So he has $8,765 death benefit, and that's going to stay there, and that will be paid to a beneficiary, because even if he uses all of the long-term care benefits in this policy, that residual death benefit stays on the policy to be paid to a beneficiary at some point. So these claims will continue to be paid until that long-term care pool has been depleted. So we're going to change gears again, or he's actually received $340,000 in benefits. Now we're going to talk about the joint hybrid life. This policy is a great policy. It works beautiful for couples, and especially if for your high net worth clients who want to protect against that long-term risk, that catastrophic risk that long-term care event could have on their portfolio. Couples love doing things together. So what do you get with the joint hybrid life policy? Well, one, it is a second to die whole life policy. So what that basically means is that a death benefit is not paid out until both insureds have passed away. Long-term care benefits can be anywhere from 2 to 4% of the death benefit. And we have guarantees again. We have a guaranteed death benefit, monthly long-term care benefit, and long-term care pool. And you'll notice at the bottom of that box, it says lifetime benefits. You also have payment options. We could do a single premium. We could do a 10 or 20 pay, or we could even do a level pay into this policy. We have options with it. So let me introduce you to Laurel and Scott. They had $100,000 lump sum that they wanted to purchase long-term care insurance with, and they wanted a shared care policy. Since they wanted to pay with a lump sum, a traditional long-term care policy was not an option. But we are able to look at this joint hybrid life policy for them. So what do they get? Well, they're going to put in their single premium, and you'll notice, look at that death benefit. It is only $109,000. That's fine. We're not really buying this policy for the death benefit. We're buying it for the long-term care benefit. And what are they? It's going to pay $4,364 a month in long-term care benefits. And it will pay that to both of them. So if they go on claim at the same time, or if they're on claim at the same time, they each can receive that $4,364. This policy is also broken up into two parts. We have our base policy, which is the death benefit, and then we have this continuation of long-term care rider here. And you'll notice this says lifetime benefits. So the way the policy works is when you go on claim, you use your own money first, which is the death benefit. Once you've depleted that, then that long-term care rider kicks in and starts paying benefits. So for Laurel and Scott, at age 68, this is what they have. Excuse me. They got their monthly long-term care benefit. They have their infinity amount of long-term care pool, a death benefit of $109,000, and their cash surrender value is $63,500. It's not the full premium, but it is something. Fast forward to age 80. Everything's the same, except our cash value went up a little bit because we had some growth on the cash value because it's a whole life policy. So let's take a look at how this works when they go on claim. So we're going to use age 80 again for the clients going on claim. And they are going to receive $8,728 a month. Why is that? Well, because they're both going on claim at the same time, and they're each receiving the $4,364. So this policy is going to pay out $104,000 a year in long-term care benefits. It is going to be subtracted dollar for dollar once again from the death benefit and their surrender value, which is their cash value. So at the end of the first year receiving claims, they have a small death benefit of $4,000 and a surrender value of nothing because they've used all the cash value up. Let's fast forward to age 90. So they received claims for 11 years. Their death benefit's been depleted. There's no cash value in this policy, but the policy has continued to pay the $52,368 a year to each of them, or $104,000 a year. So if we look at what the total benefits paid out of this policy are, they've received $1.1 million in benefits. For your clients that are worried about that catastrophic long-term care event, yes, in the future, $4,000 may not seem like a lot, but I bet you they would rather have the $1.1 million in their bank account than have it missing because they were paying for long-term care benefits. Now, if they want larger long-term care benefits, no problem. Just put more money in up front, get a bigger benefit. You can always do that. But what I want to point out with this policy is it protects against that catastrophic loss. It saves them $1.1 million, take out the $100,000 they put in, so it saves them $1 million from their portfolio in receiving the benefits from this long-term care policy. So underwriting, there is underwriting that is needed on these hybrid life policies. With the traditional policy, you can have various rating options available. You got from preferred plus all the way to standard available on them. There is a paramed exam that's required, and they are going to order medical records. Pretty standard underwriting for any type of life insurance policy. On the supercharged policies, it is either an approved or a decline on them. There is no middle ground on those policies. They are going to order medical records. They are also going to do a cognitive phone interview just like they do on traditional long-term care. And our 20th fact for hybrid is, with the hybrid solutions, there are several different options available that we've kind of covered today. So what we've done, and this chart is available on our website under the advisor section under advisor tools, it's to help you when you're thinking about a hybrid solution for your clients, which options may be appropriate for them. So for example, if they have an existing annuity and they want to look at a hybrid option, hybrid annuity is their only choice. They have existing life insurance. Well, you can look at any one of the hybrid options is available to them. Let's say they may have some health issues. Well, then that hybrid annuity may be the best one for them. Or what if they want inflation protection? Well, that's going to either be the supercharged or a traditional long-term care policy. So depending on what it is important to the client is what's going to be important, or is going to dictate to us what options are going to be available to them. So I know we've covered a lot today. So we went over hybrid annuities, hybrid life insurance, and joint hybrid life policies. Coming up, we are going to be going to a few conferences. Fall season is typically conference season. So the first one up is going to be the XYPN Live from September 23rd to 26th. Hopefully we'll see some of you there. If we don't see you there, we'll probably see you at the NAFRA conference in the fall. And then finally ending the year at the ACP conference. 10 things that make us different than other people. Well, one is we do these monthly webinars free of charge for our advisors. Coming up next month, Mark's going to be talking about the top 20 reasons to have an individual life insurance policy. Should be riveting hearing him talk about that. 10 things that make LLIS different. Well, we are not your competition. We don't manage money. The only thing we do is insurance. And for those of you who have worked with us can attest to it, that the only type of insurance we talk to your clients about is the type that you're recommending to them. We don't try to turn around and recommend other types of insurance to them. Our only clients are fee-only advisors. We are proud sponsors of all of these fee-only organizations. And we have specialists for all the different product types. I am your annuity and hybrid specialist. I also specialize in term insurance, but we have a specialist in the office for disability insurance and long-term care. And finally, if you haven't had a chance to check out our portal that we call LLIS, I suggest you do that. It is a great way to see all the information on your clients. If you want to know where they are in the underwriting process, you want to see what quotes have been sent to them, it is all there in LLIS, and your clients have the same access to their individual records as you do. Well, thank you, everybody. This has been a great time, and I hope you have a wonderful day.